Into that. Session's underway. Good morning, everybody. Welcome to today's webinar. And as you can see, it's from our friends at CMR Insurance Services who look after our trade credit insurance facility. With us today is Sam Dillon and James Early. Guys, as always, I would just like you, if you can, to pop questions into the chat box. We'll hold them to the end. I've already been sent one or two already, which is great news. So we'll have a nice discussion later. Full attention, please, because I think this is quite an important facility and coming into a busy period as well. So for trade credit insurance. So guys, for me, over to the boys, and I will chat with you later, lads. I much appreciate this. See you later.
Thank you.
Hey all, Sam Dillon here from CMR Insurance, Business Development Manager here with CMR for a couple of years now. This is James.
Good morning. I'm an account manager at CMR, so I look after policies. I've been in credit insurance for 30-something years now, so as long as I want to remember.
More than me, yeah. So thanks for joining, and we're just going to get into it. Right, so today's agenda, we're going to start with learning objectives. So we'll go through those in a moment, and tell you a little bit about what you'll be learning today. Obviously useful for CPD. The background to CMR, so explaining a bit about our experience and our expertise in this sector. The type of risk that we're covering, so we'll give you a few examples of recent claims, businesses that might have gone insolvent that you might have heard of, and what the risk is there. What is trade credit? So trade credit, we'll talk you through exactly what it is, and we'll also talk you through the benefits of trade credit insurance and the type of cover that we give. A new business journey, so we'll talk you through once you would introduce a new business to us, the journey that they go on with us and the sort of timescales and process behind that. Establishing credit limits and underwriting, how we establish credit limits on specific buyers, and also our underwriting piece as well. Our claims process, the process of both types of claims. So we have insolvency or any type of administration. We've also got non-payment, so we call protracted default. So we'll talk you through both of those and how they work, and also the different types of policies that we have. So we're on the learning objectives. First of all, we'll be understanding trade credit insurance, understanding the risks there, the benefits to be insured, and we'll also need to appreciate the importance of trade credit insurance to a company. Is that implement trade credit insurance are doing it for a reason, and they tend to stick with trade credit insurance once they first start because they really see the benefit and value behind it. Over to James.
Okay. Yes, CMR as a company, we've been in business for over 30 years. All that time we've worked with traders as a scheme manager. We only cover trade credit risk. We don't do any other type of purely credit insurance. Credit insurance is all for business purposes. It doesn't cover private.
Sorry, James. Sorry, mate. We can't hear you. With just a couple of comments from the floor that we can't hear you. So can you just do your best just to speak up if you can, mate? That's great.
Yeah. Commercial lines, it covers business-to-business sales. So it doesn't cover if a company is selling to private individuals. That's not something that's insured.
Sorry, James. I don't want to interrupt like this. I'm so sorry. We are struggling to hear. I don't know if you can move the laptop slightly so it's slightly better.
Let's try that.
Is that better?
Speak a bit louder than natural, James. I think that would help us.
Okay. Commercial lines.
Perfect.
Commercial lines covers business-to-business sales. It doesn't cover you for selling to private individuals, but it can of a non-limited company, sole traders, anyone that's acting in a business capacity. Also, CMR are the scheme provider, hence this webinar. We've been partnering with BIBA since 2018. Over to you.
Spotting opportunities. So when we look at spotting opportunities, we're firstly looking that they are a business-to-business trading business. So they are selling to other big businesses on credit terms, offering a specific period for their clients to pay invoices. Credit terms need to be offered. So within these policies, the client can offer up to 180 days payment terms to their clients. Some opportunities, well, a lot of opportunities come from the receivables financing industry. So when we talk about invoice financing, factoring, invoice discounting, where they actually fund invoices that are sent out on credit terms. Because they're sent out on credit terms, the financiers are able to release cash on those invoices early. But at the same time, we can insure those invoices in case of non-payment, which then secures the business, but also it secures the funder. Growing businesses, so businesses that are moving into new jurisdictions, moving into new countries, selling into different countries or different industries, should we say? You might not know much about where they're selling to, so having trade credit insurance gives them that credit information of who their buyer is, whether they're credit worthy, and if they should be selling to them essentially. New products, so if they're selling new products the same way, they're selling new products, it could be to a range of new buyers. So just to have that credit information is really valuable for them. And new markets as well, like I said, it's moving into new countries. And like I said, it is really valuable stuff for businesses and makes them trade safely. So risk, back over to James.
Okay, so the risk is debt, but looking at some of the issues around that. So insolvencies were always expected to increase after the COVID support schemes dropped off, the various government schemes that are being offered in the UK and elsewhere, and that certainly has come to the case. We're seeing a sharp increase in the number of insolvencies. For example, in the last 9 months, over 4,000 UK construction businesses have gone into insolvency. Some large cases there, which you probably all heard about, and it just reinforces the size of companies that are going under. Henry Construction in particular, that left a massive amount of debt, which the insolvency practitioners are still trying to go through, because the company records were basically non-existent when they went in. The impacts of bad debt, the impact of rising energy and transport costs that we're all seeing, the impact of the war in Ukraine, that's all hitting companies across all sectors. The number of CPLs are the highest since records began in 1960, apparently. And just to reinforce what the impact of bad debt to a company means, this example is quite good. If a company is trading with a 10% profit margin, if they suffer £100,000 bad debt, to make up that loss, they have to conduct an extra £1 million worth of trade just to get back to square one. Obviously, they've also lost a large customer, and they have to recoup that as well. So, a relatively small debt in overall scheme of things can have a massive impact on a company's profitability. Just going into a bit more detail on what the policy is and covers. It's there essentially to cover the risk of non-payment by the customer for goods or services that have been sold to the company on credit terms. Information is included within the policy. We track the customers that the company is selling to. That's monitored by the underwriters. So if they get adverse information during the year, that's fed back to the policyholder. It helps them manage their risk as well. Credit insurance is not often seen this way, but it is a valuable sales tool for a company. They can search their database, see which customers are good at risk from the underwriter's point of view, and they can focus their sales there. I often say when somebody gets a nil credit limit decision, that's often the most valuable, because they might think that company's quite creditworthy and a good risk, but in the background there's other issues going on which might not be in the public domain, and it can help a company avoid those type of buyers and focus on the more profitable customers. Insurance allows the client to trade. It's that security of knowing that if you are hit by bad debt, you've always got the policy to fall back on.
So a few benefits of trade credit insurance. My background comes from the invoice finance sector.
Sam, sorry mate, it's not working. Mate.
Hear me now?
Got you now, thank you.
Sorry. So, a few benefits of trade credit insurance. My background comes from the invoice financing sector, where we would also sell trade credit insurance alongside financing facilities. So, like I explained earlier, it protects the cash. So, replaces any money lost in the event of a bad debt. So that's insolvency of your buyer, or your buyer just not paying but continuing to trade. So it's really essential when it comes to financing. It can help protect the security that a director might give to a financier. It also protects the business in the form of, if they're claiming on a bad debt, it essentially protecting their business and making sure there's, continuity to their business. So it's essential in there. Supports revenue growth. So secure growth by allowing the increase of exposure, so you can go into new markets, like I said, domestic or export, selling into new countries, that businesses might not be aware of, or have just come across a new buyer, let's say, in a different country. They've got no idea who that is, and trade credit insurance gives them that credit information that they need to be able to trade safely into those new markets. And peace of mind. See, it's insurance, it's all peace of mind, but this is protecting one of your largest assets of your business. So as you would protect all your other types of risks, this is one of the largest risks that a business has. So it's quite key to have this type of insurance if you are trading B2B on credit terms. Like I said, it gives you more access to finance as well. So by protecting your invoicing, you're protecting your receivables. The financier will look more favorably on you. You might get better rates from a financier, knowing that if there is a bad debt, that their cash is protected. The information is essential to all businesses as they're going into new trades, or whilst they're trading with a buyer. So if you're going into a new trade, you'd want to check out your buyer before. As you continue to trade with that buyer, the insurer will always be sort of monitoring that buyer for you in the background. And if anything changes with that risk, you'll be given notice of any changes to the credit limit you hold on them. So it just sort of manages that risk and lets you know what's happening with people you're trading with.
Can I just have something into that, Tom?
Yeah.
Just an example that came up recently where one of our policy holders asked for cover on a fairly well-known named business, and they told me that they've been after this customer for some time. They applied for cover and actually got a nil decision because the company is in financial difficulties. Really used up all the credit facilities that they already had, and were then going to this other supplier for good services and credit, hoping that they could extend their credit by going to new companies. So that's information that they wouldn't have been aware of if they didn't have a credit insurance policy. And it's a company that they would have otherwise felt secure in trading with directly. So it's that valuable information that's a real benefit of credit insurance.
Thanks, Dave. And lastly, the cash flow aspect of benefit is towards the cash flow of the business, as this is a policy that's implemented into your credit control procedure. Also brings down your debtor sales outstanding days, so brings in your cash quicker because you have a monitoring period of how quickly your debtors are paying. If they don't pay within a specific period, we would report that buyer to us. That firstly helps us in monitoring how quickly a buyer is paying. If there's lots of clients reporting late payment from a specific buyer, then start building a picture as to what's happened with that buyer and whether we should continue to offer credit insurance against them. But yeah, generally it helps businesses bring in the cash quicker and so improves their cash flow. Moving on to the new business journey. So when a new business is brought to us, we would send an indication form directly to the broker. Broker can either run through that with the client or ask the client to complete it. That is the form. It's quite a short one-pager, collates the information about previous years of turnover, if they've had any bad debts in those years, and what the sort of value of those bad debts was, so that we can sort of get an idea of what the premium might be for that buyer, for that client. We do a review of the top 10 buyers for you for free. So whether they take the credit insurance policy or not, we can review the top 10 buyers of a client. Gives them an idea of how creditworthy their largest exposures are. So whether they take it or not, it's probably a good idea to come to us with their top 10 buyers anyway, so we can have a look at them. We do a non-binding indication of terms. Once that's come back, if the coverage across the buyers looks good, then we'll contact the client or the broker and say, this is what the coverage looks like. This is what a quotation for a 12-month policy would be. Okay. For acceptance of terms, we would run through a proposal form, which collates all the information that we need, allows us to do our due diligence in the background prior to raising policy documents. Once we raise policy documents, they're sent out by email. We can send them direct to the client or to broker as well. Entirely up to you guys how you wanted to work with us. Once we've sent them across, we arrange most of the time we prefer to do a face-to-face meeting because it's quite a detailed policy, and I think it entails a lot of understanding. So we like to do a face-to-face meeting just to run through exactly what's required in terms of reporting and just understanding the policy properly. So once the meeting's been held, the policy is accepted, and we do a training on a system which allows them to run credit searches for use of what we call a discretionary limit. We'll run through that shortly. And also how to use our system to report probable loss and claims. There's also ongoing support from our dedicated administrators. We've got a team of people within the office who do day-to-day credit limit applications, deal with debt collection piece, and also administration activities. Switching credit limits. So this is just telling you a little bit about how we establish credit limits. So when a credit limit is requested, there's a few ways in which we can look at different aspects and establish a credit limit essentially. So the first, get back to that. The first way is to speak to our underwriters. So we'll put a formal application into an underwriter, and specific underwriters for specific sectors. So you'll have one in construction, one in manufacturing, one in agriculture, etc., etc. They know that sector quite well, and a lot of the time they hold direct relationships with finance directors, CFOs of large corporations, so that they can get up-to-date management information on a regular basis, sort of are in the know of the financial, the current financial situation of those businesses. So that's the first point of call. But the underwriters use lots of different avenues to establish a credit limit themselves. So Companies House and credit reference agencies is just one of those. Obviously, though, the Companies House and credit reference agencies will always store their most up-to-date accounts. And generally, they do provide a credit limit on a credit reference agency, but that is obviously based on the last set of accounts, as the underwriter might have more up-to-date information on that. So we can also contact the buyer directly. The underwriter can do that anonymously, or if the client is happy to, we can use the client's name, which we always ask permission for first of all. If we can use the buyer's name, client's name, we can contact the buyer and say, your supplier is looking for a credit limit on you. Can you provide X, Y, and Z? And it's normally sort of management accounts within the last sort of 2 months that can help an underwriter to underwrite a limit for them. The policyholders directly. So when it comes to reporting, they will report something called probable loss. We have something called a maximum extension period on our policies, which is normally between 45 and 60 days. And the maximum extension period is an additional period on top of the credit term offered, in which we allow the buyer to pay. If the buyer hasn't paid within that period, the client would report probable loss to us. That's where the client hasn't gone, the buyer hasn't gone insolvent. They continue to trade, they just haven't paid. At that point, we start a debt collection process, which we'll go through shortly. The discretionary limit is for your smaller end buyers and smaller end credit limits. That can be established either by running a credit reference agency search via our system or via the client's own credit reference agency if they've got their own subscription, and we use the credit limit that the credit reference agency offers, or we use payment experience. So when we look at a prior 12-month period, during that period, how much has our client traded with the buyer? And if we can say, they've got a discretionary limit of £10,000, if they've traded £10,000 over the 12-month period prior, and they can evidence that, they can give that buyer £10,000 credit limit for the next 12 months. We'll go into a bit of detail on that discretionary limit shortly. James, to talk about claims.
Okay, just to run through the two types of claims and the process that would be taken. Insolvency claims, these are the most common at the moment. That's obviously where a company goes into administration, formal insolvency, a winding up petitions issued, or where there's a voluntary arrangement, a CVA as it's called. The client would notify us as soon as they're aware of the insolvency. They should notify us through our system. The company would get confirmation of their debt from the insolvency practitioner. They'd send that on to us. We at CMR do a pre-claim assessment. There isn't a claim form to fill in for the policyholder, so it's a nice, simple process. And we put a fully completed claim up to the underwriter, which ensures that it's dealt with quickly and efficiently, and a claim is paid as early as possible. Another type of claim is a protracted default. That's where the customer is still trading, but obviously they've had cash flow problems. There's something that's meant that they're not able to pay the debt on time. A protracted default claim is paid by the underwriter or accepted by the underwriter at 6 months after due date of an invoice. So in that 6-month period, they and ourselves would take collection action to try and recover the debt If all else fails, at 6 months past due date, it can go to a claim. The process is similar. They notify us at the end of what Sam referred to, the maximum extension period. So that would be typically 45 to 60 days past due date. They report to us. We would take over collection action at that point for them if they wanted us to. The debt, hopefully would be collected, or we'd arrange some sort of payment proposal, and it would carry on to that. So we would collect the debt, and the case would be closed, and it wouldn't actually have to go on to a full claim. Alternatively, if the debt collection wasn't successful, again, we'd get the rest of the documents from the client, the commercial documents that they've got relating to that order and sale, and we would do our pre-claims assessment. If that's all together, we would put the claim up to the underwriter, and again, efficiently to the claim, and the claim would be paid. If it's an outstanding debt, collection action might carry on past that point. If there's prospect of recovering the debt, obviously we want to do so. The collection action might continue. The recoveries that come back from the buyer would go back to the insurer, and they would share in proportion to their liability for the claim. They'd share that recovery with the policyholder. So ultimately, if the debt was fully recovered, the claim would end up with the full debt repaid back to them, even though there's a claim paid in the interim. Touching on the collection process, it's part and parcel of the policy. We do the collections in-house, and we also link in with the underwriters, collection offices around the world where we need to. It's provided on a no collection, no fee basis. So we only charge a fee if we're successful. Collection and legal costs are covered by the policy for insured clients. So as long as the debt is insured, then the collection costs are also insured. That's quite a benefit, especially with export debts, because the cost of collection and legal costs in export markets can be significant. The good news is if a client has to make a claim for collection costs, so the debt being recovered, but there's a cost for collection, that claim doesn't affect their claims record on the policy. It's a ring-fenced benefit of the policy.
Just to jump in, James.
Yeah.
We also offer debt collection for uninsured clients. So if there are debts that need collecting, then we can offer that. It will also be on a no-win, no-fee basis, but obviously the cost wouldn't be recoverable because it's not an insured client.
Just looking at the various policy types, there's different types of policies depending on the size of the company and the type of risk that they're looking to insure. The majority of our policies are a fixed price policy. That's where they give us an estimated turnover at the start of the year. We calculate a premium based on that and the other factors that Sam's mentioned, and that price is fixed. So if their turnover exceeds their estimate, they don't pay any more. If they achieve the estimate, there's no rebate, but it works out year on year. That's typically up to £10 million insurable turnover. If the company's larger, they've got more than 10 million turnover to put through the policy, then it would be what we call a variable policy. The cover is identical. There's no difference in what the policy covers. It just means that the customer would put a monthly declaration of sales through to us at the end of each month, report their sales for that month, and they'd pay a premium based on that monthly level of sales. There is an estimated premium up front based on, again, the estimated turnover that they give us, but unlike the fixed policy, it is variable. So, if their turnover exceeds their estimate, they'll pay the premium on the actual turnover. We can cover startup companies. So a company that's just started or with less than 1 year's trading history. And the other type of policy covers single risk. Although it's single risk, it does actually cover up to 4 individual buyers or risks under that policy. Single risk is beneficial where somebody has a particularly large contract that's outside of their normal trading activity and they're worried about the risk, and can be covered. And it's also a good stepping stone into maybe looking at whole turnover cover for that company as well. It is more limited in what it covers. It's just solvency of the customer, and it's only for certain markets, so the UK, EEA markets, USA and Canada. All the policies, fixed price variable, startup, it's UK turnover, export turnover, combined whole turnover. Each policy is tailored to the customer's needs. So again, depending on the information they give us, depending on the size of their customers, number of customers, we'll put a policy structure together that's suitable for that particular client.
To the structure of our policies. All of our policies are on a 12-month basis, although we can authorise 24-month policies, be competitive if we need to. The policies all cover, all of them cover 2 aspects. If you've got export, you also have political risk. So within all of our policies, we're covering insolvency of the buyer, protracted default, which is non-payment, and political risk, whereas export debt. Goods and services are both covered. So it can be simple sort of sell and forget type business, and services could be anything from recruitment to construction. Construction is a sector that we're seeing lots of claims in at the moment, so it's sort of case by case at the moment whether we can write cover on specific buyers for construction. But yes, services wise, construction bill in a very different way when it comes to applications for payment and variations. So we're able to tailor a facility, a policy specifically to the construction industry, to make sure it works for them. We can cover work in progress and what we call pre-credit risk. So if there's a manufacturing period that our client has, it can be up to 6 months. We cover the risk where they might receive an order from a buyer. It might take them up to 6 months to produce those goods, whether they're manufactured in-house or whether they're outsourced. It can still be insured, and our pre-credit risk will cover them for the overheads during that period. So it ensures that they essentially break even should there be an insolvency of the buyer during that period. That is pre-credit risk is only an addition to a credit risk policy, so it can't be taken out as a sole policy itself. Indemnity on these policies is 90%, but where there's political risk, we have 95%. Political risk could be considered, for example, the war in Russia and Ukraine, where there might be some sort of turmoil in specific countries, disasters. Yeah. So it's sort of the insurer to highlight where a political risk might be, and then the indemnity there is 95%. The deductible is £500 or 10%, whichever is the greater. And that's the minimum retention on these policies, essentially in excess. The maximum terms of payment available that you can offer to your buyers under these policies is 180 days. We wouldn't suggest offering 180 days to anybody, but I do know of a buyer in the UK that does work on 180 days, and that is Boots. Boots will only do 2 payment runs in a year, so if you work with them, they'll have 180-day payment terms. So moving on to some benefits to our Viva members. Marketing material we have available on the website. You've got face-to-face broker and client training. So we, like I said previously, we onboard a client. We're happy to go and meet them directly face-to-face, run them through training on the policy and our portal. We can also do that directly with the broker as well, just to give them a better understanding of it. Ongoing support is through an account manager. So each client will have an account manager, and we'll also have an admin team essentially to run through sort of credit limits with. There's also our debt collection team they would speak to when it comes to reporting probable losses, or even if it's an uninsured debt, they can run through the debt collection team for that. We only provide trade credit insurance, so we don't offer any types of cover. Speed of response. So in our industry, there's a lot of, should I say, slow responses. We pride ourselves on our customer service and speed of response. I tend to get that directly from my financing days, where if somebody needs cash, they need it yesterday. So always quite quick to a new opportunity. So yeah, if you need anything, feel free to email me directly or give me a call and I'll jump straight on it. For Beaver members, we have a 10% introductory commission. So, and then we have a 5% on renewals as well for you. The trade credit guide was produced, I think it was last year, and that's on the Beaver website. So feel free to download that. There's a lot of good information in there. I think we spent a lot of time creating it, so it's definitely worth a read. So to summarize, the key things with trade credit insurance, the key benefits here are knowing your customer. We all think we know our customers. Businesses think they know their customers. They might have a good relationship. If things go in the wrong direction for that customer, perhaps they take a bad debt and it impacts their cash flow negatively. You wouldn't know of that. So having trade credit insurance will give you that information and continuous monitoring of that buyer to ensure that you're trading safely. So I would always say implement it into your credit control. So prior to trading with a new buyer, you've got a trade credit policy, you apply for a credit limit with us, and you know what limit is safe to give to that buyer, the credit limit. Collections wise, it's all done in-house. So we're proactive, well experienced, 30 years experience within this industry. We've got a professional collections team, qualified and regulated as well. So we're good at what we do, we know what we need to do, we do it well. Claims wise, if all else fails, if we can't collect the debt, then we can put a claim in. And the main thing is that we've tried to collect it, we've tried to monitor the buyer to see if we can withdraw or reduce cover beforehand. So we've tried to reduce our exposure as much as possible prior to putting a claim in. If we have to put a claim in, then we do, and we're very well versed at putting claims through. We've been working with Atradius as a scheme provider for a very long time, and so we've got a very good relationship there, and they ensure that the service that they provide us is great. Moving on, to contact us, you can follow us on LinkedIn, Twitter, Facebook, and the dedicated Beaver website as well. All our details are there, and you've got our email address and phone number below. That's all for today. So thank you for your time, and any questions, feel free to pop them through. And we look.
Perfect timing. My phone goes off as soon as I open up my speakers, so apologies for that. Thanks for the battle, guys. That was just a bit of a battle with regards to your sound. So we'll probably try and get another one booked in sooner rather than later. But thanks for the efforts, and obviously out there in the audience land, apologies for some of the sound quality there. We have had a few questions coming actually, guys. So. First one from Sue. What amount of debt triggers a claim? Is this preset at inception, or does it vary throughout the term? And if it varies, is there a minimum debt amount that triggers a claim?
The policy has a deductible, as Sam mentioned. It's typically £500 minimum retention. So if the total debt that the policyholder had was £300, let's say, we could still try and collect that for them, but they wouldn't be able to make a claim for it. If the debt's more than the minimum retention of £500, then they can make a claim.
Okay. So I hope that answers the question for you. Thanks for that, James. Just going on to a couple of others, actually, guys. The broker, what would they have to do in terms of servicing the clients, as obviously they're not familiar with trade credit insurance?
So on that, it's entirely up to them how they want to go about it. Normally, we would take over the servicing aspect. In-house, we've got account managers and, like I said, an admin team. So you can hand it all over to us, and we specialise in the trade credit piece. So, and it's quite a detailed policy as well. So I think it's probably worthwhile us maintaining the servicing aspect. But obviously, we'll keep you in the know as to what's going on.
Thank you for that, mate. Okay. Next one, let's have a look. You mentioned visiting the client and for training. When they take the policy, but would you be able to help later on, say, if a person is dealing with the company left and somebody else joined?
Yeah, absolutely. We're here for the client.
Louder, James. Sorry, mate.
Yeah, absolutely. We're here for the client. So if it does happen quite often, somebody leaves and they get a new controller in who isn't familiar with credit insurance. So we're quite happy to visit them, take them through it, do it through a team call, however they want to do. But yeah, we'll retrain as and when required. We also go through a refresher on everything each renewal with the client as well. So we make sure that they're up to speed on everything after each renewal.
Thank you, James. Thank you. 3 last quick questions, actually. The first one was, how does somebody open an agency with you guys?
It's pretty straightforward. If what we tend to do is, if you've got a new piece of business for us, contact me directly or contact the email address there listed. I'll get in contact. At that point, we send you an application. Complete the application, send it back to us, and we'll send over the TOBA.
Sam, thank you for that. And there's a couple ones about sort of timing of covers. How quickly can you incept a trade credit policy?
If I'm being honest with you, last month I think I did a world record, 24 hours, and it was completed. So I won the award last month, but it's not normally that quick, to be honest. But if I've done it in 24 hours, it can be done that quickly. And
what would your normal day be?
The normal, I would say, is sort of 3 to 5 working days. If the client's playing ball, if not, it can take up to 7 days, to be honest with you. If I get everything that I need, it's quite a quick process. Also, just to let you know, we do backdate cover. So let's just say you had a client who wanted to cover their invoices this month. You could backdate to the 1st of September, cover the invoicing raised from that date onwards.
That's right. Well, that was actually going to be my next question. Well done. You read my mind there, Sam. Well done, mate. Thank you very much. We'll just give the audience another minute or so to think of any other questions. We'll just need to maybe put another session on with guys. I don't know whether it was because you were sharing the laptop that the mic's not quite picked either of you up. I'm not so sure, but
a bit odd, isn't it? Because before we did
work before,
it's all right, wasn't it?
Yeah, it has worked before. So obviously, listen, the message we got the message across, and I'm sure everybody out there who was able to hear us enjoyed this session. I certainly did, and obviously, it gives me a further look into trade credit, and obviously, we'll move this forward. We'll take it away to Juliet and see what other dates we have, just to do a further follow up on this, if you want, guys.
Sounds good. Yeah.
Just as the audience, a big thank you from me, guys out there. Any further questions, or just let me know you've had enough from the session today. nearly said I had enough of us then. I thought, I better not say that. Really.
Thanks for attending as well, and apologies
Thank
about the sound.
So that's been it's great. We're always appreciative of you putting the effort into putting a session on. We know it's time out of your day, so yeah, we're just getting a big thank yous, guys. It's coming through. So well done, well battled. Obviously, there is the recording that's online, so we'll have a look back at that, and maybe the three of us will get together and just work out what we can do better next time. But for now, lots of people saying thanks, so it couldn't have been that bad, guys. Let's put it that way. Now, obviously, I presume if anybody has any issues or any questions around trade credit at all, and then they're not so sure about the product itself, just put a phone up on the number that we're showing there, and you'll help them through.
Yeah, absolutely.
Brilliant, guys. Thanks. Audience, great to see you again, guys. Hope you're all keeping well out there. Stay safe. Keep away from that nasty COVID that's knocking him out. There's a lot of it around at the minute, so stay healthy, and we'll catch you all on the next session. All the best. Take care. See you later.